Good afternoon. I hope everybody's doing well today. Thank you guys for joining us. And our presentation that we're going to do today is on getting long-term care right. Antonio, if you want to share your screen now, we can throw up the first slide. And I actually have the luxury today of primarily sitting back and listening. I have plenty of stories, I'm sure. So I'm sure I'll probably chime in as we go through the presentation. But my partner, Antonio, is going to present. I will let him introduce himself. But for those of you that, I think I know everybody on the call, so I'll spare you my introduction. And I'll let him kind of just jump right in here. Couple, quick housekeeping things. This is our one of our monthly series that you're attending, of course, today. So for those that aren't aware, we are doing these once a month on different topics, and then every quarter we're doing an economic update as well. And just FYI, we are recording these presentations, but they're not publicly available. So if you do want a recording, we can send that recording to you. You just have to request it from us. And that's also a key point too. I know these are always the third Thursday of every month at 4:15. That may not always be convenient for you. So if you in fact want to listen to a topic that you're not able to attend, please let us know and we can get you that recording after the presentation. So with that, I will hand it over to Antonio and I'll let him get started with long-term care.
All right, thanks, Ryan. Good evening, everybody. I was looking at the names as they were coming into the Zoom meeting, and I think I've actually met or spoken to most of you on this call or on this webinar at some point in time this year. Some of you actually very recently, I noticed. So with that being said, again, my name is Antonio DeSano. I started with the firm back in January. Ryan brought me on from a firm I was at called Bluemark. We were associated with the Ameriprise. I was a financial advisor over there. Been a financial advisor for about almost 11 years now, really with the focus on financial planning. So I got my certified financial planning certification probably about 6 years back now, 5 years ago at this point in time. And so I was actually excited when Ryan, asked me to sit on this and give this presentation because I always preach long-term care, almost in every single meeting that I'm in, unless obviously if it's somebody maybe that's 25 or 30 and we're doing entirely different types of financial planning. But most meetings, most clients we work with, they're at that stage in their life where they're, approaching retirement. Maybe they are retired, and this is an important topic and a relevant topic. So, a lot of people, have questions around this too. So we, as I go through this, feel free to message, or there's a little chat function in the Zoom here for some of you that may or may not be aware. So if you have a question, you can just type your question in there and Charlie will let me know, and we'll be happy to adjust questions as we go. I don't promise to know every single answer. If I don't, but between Ryan, Charlie, and myself on this webinar, one of us should have an answer for you as we go through. So, all right. So to get things started here, we got a little quiz. Just 3 questions, pretty straightforward. So I'm going to give you like 20 seconds to do this because it's kind of more for fun too. So just want you to match the correct answer to the correct statement. So you have 3%, 8%, or 70%. So first one, letter A, what percent of Americans over 65 do you think that will need long-term care? So, and then letter B, the percent of Americans who think it is very likely they will need long-term care at some point in their lives. And lastly, letter C, the percent of Americans who actually have long-term care insurance. So again, those the answers are at the top, 3%, 8%, 70%. Just think about that. I'll give you, like I said, 10, 15 seconds really quick before we kind of go over the answers here. Actually pretty, I guess it's easy since I know the answers. All right.
You didn't answer?
What's that?
You did.
I'm sorry, was somebody trying to say something? Oh, I thought I heard something. All right, so the first letter, A, so the percent of Americans over 65 who will need long-term care. That is the correct answer. If you said 70%, you got that right. So that has increased dramatically over the last 10 years. It was at about 50% back in 2010. That has steadily increased and climbed, as you can see, over the last 12 years or so. Next, letter B, so the percent of Americans who think it is very likely they will need long-term care at some point in their lives. Now, if you answered 8%, you are correct. So you can see very big difference from the last question, where 70% of individuals over age 65 are going to need long-term care, and only 8% actually think that it's very likely that they're going to need long-term care at some point in their lives. Next, letter C, the percent of Americans who have long-term care insurance. Now this number is even lower, as you can see, the last answer, 3%. So this is kind of a good tee up. Now, actually, I'm going to stop. Did anybody get all these right? And be honest. Anyone got all these right? Yeah, you can unmute
Type it in the
yourself.
chat or unmute yourself. There we go. A couple hands risen.
Two people?
Yeah.
Jen, Michelle, okay.
Steve as well.
Wow, congratulations.
Like
Yeah, I feel
Kim
like we
got
need
them
to
right
send you
too.
like a,
I did.
that's actually, I was expecting maybe one person to get all three right. So that's very impressive. I'm gonna give credit to Ryan for educating all of you over the past years that you've been working with them. So very good. And the reason I like to start with this quiz is this really centers around what this whole presentation is going to be about. Is long-term care is a very serious topic. It is what I call a financial blind spot in majority of the financial plans that I've done with people and individuals that I've worked with and continue to work with. You know, it's something that's not obviously fun to talk about. I kind of put it in that same bucket as estate planning. People don't like to talk about estate planning or long-term care, things that are kind of associated with aging and, bad health or passing away, things like that. So kudos to all of you for attending this and taking this topic seriously, though. So the main problem here is
Hey, Antonio,
planning, right? Yeah.
If I can jump in just real quick, just going back to, and Antonio mentioned it earlier a little bit, but if you do have questions, put them in the chat box or unmute yourself and feel free to ask the question. But if you don't have any questions at the moment, that's fine too. But in that case, if you guys could keep yourself muted just so we can keep any background noise down, that would be great. Go ahead, Antonio. Sorry about that.
Yeah, no problem. Obviously, feel free to jump in. All right, so the main problem of what we're here to address and talk about is, to surround, the topic of long-term care planning and having a plan. So as you can see, when it comes to planning, everybody wants to have that safe, secure retirement. And as I said, one of the big financial blind spots that can blow up any, majority of retirement plans that, I see for multiple individuals is long-term care. And it remains a very confusing and, as you can see on the screen here, unaddressed challenge to many people's financial security. Again, it's just one of those things that people, they may know it's important, but they just don't want to talk about it. They want to kind of kick that can down the road and just not have that conversation. Or we have conversations that, in meetings where it is very important, but it's like, all right, where do I go from here though? I feel like I have enough money or so-and-so's going to take care of me. I don't know how to address or come up with a specific plan for long-term care. All right, so why are people not planning for this critical issue? As you can see on the right here, we have a number of bullet points. So starting at the top, seems very remote, very far off. This isn't always the case. We could, if somebody, is maybe, in their mid upper 60s or early 70s, it doesn't seem really remote or far off in their case when we have some conversations. But for a lot of people, really, it's good to start planning the sooner the better. because obviously you can save on costs, you can just say it's going to have more benefit down the road, things of that nature. So say someone maybe in their early mid 50s, that's where I hear and get this a lot, where it's like, all right, I don't need to worry about that. I'm healthy, I'm thriving, I feel great. It's really, I know it's important, but I'd rather just kind of pick this up and talk about, 5, 6, 7 years from now. Next is that false sense of security. This is another big one. As far as, well, I'm okay, I have a lot saved up, I can self-insure, I have so-and-so that will take care of me. Nah, I'm really healthy, I have good, family health history and longevity. I'm okay, I don't need that stuff. Another one is don't want to think about it. This one's very common as well, as I've already kind of addressed a couple of times over the last few minutes. It's just, I don't even want to talk about it. This might be the biggest one I've noticed in the last 2 or 3 years, is around Medicare and Medicaid. And everyone thinking, well, I have Medicare, that's going to cover it, right? That's going to pay for it. I've seen this mentality grow again the last 2-3 years, just to kind of, for whatever reason, I'm not really sure. But this is one trend that I've seen, and we're going to address this in the later slides around the Medicare and Medicaid. Also, some people don't expect they might need long-term care. Fair enough. That kind of goes into false sense of security above. My family will take care of me. Okay, that actually, I had somebody I think they were kind of joking about this. This is about 5 years ago. We're talking about long-term care, and somebody, the client I was talking to about it, they're like, oh, well, I have kids and I have daughters, so I'm okay. If I had sons, it'd be different. My family, because, their thinking was, well, daughters typically take care of their parents better than, their sons do. I was like, well, that might be true. I have no idea if it is. I hope it is. I have 2 daughters, so I guess if that is true, it's good for me later down the road. But it's not really a long-term care plan to bank on that. Again, this is a big one here that we have some slides coming up that are going to address just the different emotional and financial stress that can cause on family members as well. It's too expensive. Very, definitely, we'll be talking more about that as far as, different, costs and, is it too expensive? Well, yes, sometimes it can be a little more expensive than your typical insurance policy. I won't sugarcoat that, but is it going to be more or less expensive than actually self-insuring and paying out of pocket all those long-term care expenses that could potentially burden your financial plan? Next, I'll just pay for it out of pocket. Again, that kind of goes back to what I've talked about earlier already. We'll definitely address that, and then just questions about whether it's really needed. I kind of bunched this one or grouped this one in with the false sense of security, or they don't expect that they're going to need long-term care. Like, is this really necessary? All right, so as I was just alluding to, as far as the mentality of, oh, my family will just take care of me, which is very common. And yeah, if it was my choice, I'd rather have a family or best friend or close friend take care of me, maybe than some complete random stranger that I really don't know, even though they may be a professional. I can understand, just the comfort level you have that there. However, there is a lot of emotional and financial risk and different costs here that this has on your family, as you can see here at the top. And I know a lot of you who've been, working, talking with Ryan, he's got a great story about this, that he's probably talked to you and told a lot of you about just the different family strifes, about the different responsibilities and care arrangements, where there can be a lot of disagreements of, okay, who's doing what? Who's going to go check on mom or dad? Who's going to take care of this? Who's going to take care of that? Who's going to drive them over, take them to their appointments, whatever it is. That can cause a lot of arguments and disagreements there. Also, the anguish about choosing, okay, best care versus high cost of care. I've seen this in my own family where some people will want the best care possible for their loved one. They don't care the cost. They just want them to be comfortable, be as happy as they can be, make them feel as good as they possibly can in the situation. Well, other people may think, well, that's too expensive. we can still get good care, but we don't need to pay so much money. So that, that could cause some issues too. And then we have what's called that sandwich generation, where they're kind of mired with that guilt, that weariness, and that financial strain. So when I first saw sandwich generation or heard sandwich generation, I actually had to look it up. So I wasn't very familiar with that term, but really it'd be somebody, it's someone in their 30s, 40s that are raising their own children, but also at the same time taking care of their loved one, their mother or their father, and trying to do both of those things at the same time. And that kind of coincides with the financial risk and stress, that you can see at the bottom here, where, sometimes people will lose out on a lot of wages or income. They may have to quit work, maybe go part-time, take less hours, just because it can be a full-time job, part-time job minimum, when caring for another family member. Also, there could be some unintended tax consequences for the estate. I don't know if that's really, I'm not really going to focus too much on that today. But also, here's another big one, is a smaller or even a non-existent inheritance. If that's important to, say you want to fund the grandkids' education, with whatever assets you have left over, at the end of your lifetime. Well, if long-term care eats all that up, then, that goal you had, no longer can be accomplished, or maybe you can only partially, fund that goal you had. That's just one example. All right. Okay, finally. All right, so this is, I kind of laugh a little bit because we hear this all the time, is I don't want to be in a nursing home, or adult daycare center, whatever they're calling them these days. So that brings us to our first key, how long-term care is not about just sitting alone by yourself in a nursing home, 24-hour care, nothing really to do. You're just laying around in a small little box room doing, no social interaction, nothing, really watching TV all day, whatever it is people are thinking it could be, all those negative thoughts. It's really about the range of services that are designed now to help people with all those different and various personal care needs and health needs that they have. So first, we'll start with what exactly is long-term care. So we call, it's centered around, these different services, a variety of services designed to support people who may or may not be able to perform one or more of these, what we call ADLs, or activities of daily living. So when I say ADL, it just stands for the activities of daily living. So starting at the top, that could be bathing. Pretty self-explanatory there. Being able to dress yourself, eating, being able to, feed yourself, transferring. What they mean by transferring is, am I able to get in and, from my bed to a wheelchair, and then from my wheelchair back to my bed? Or, that's just one example of transferring. Toileting, pretty self-explanatory, with that one. Incontinence. And then also down here at the bottom, there's also hands-on care versus standby care. Full hands-on care could be where, a health professional or a home health aide or our nurse, has to help you perform, one or more of these ADLs, or activities of daily living. Standby care is more or less, they're kind of just there to observe. They may or may not have to assist you. It's a little bit less level of care. So we had this big disconnect, so who's going to need long-term care? So this goes back to that quiz that we started off in those first few slides. So the expectation here on the left, only 8% of people think that they will need long-term care at some point in their life, versus the reality, almost 70% of people turning 65 will need long-term care, and that's as of 2020. By year 2030, that number could, I believe all baby boomers are going to be age 65. So that you could easily see this number on the right go up even more. So there's different long-term care settings. in each setting that you see listed, these bullet points on the left, so at-home care, community-based care, independent living, assisted living, nursing home, when you go top to bottom, you get more and more aggressive, or not aggressive, but more and more in depth or detail with the level of, it's a higher level of care is what I'm trying to say. We'll kind of go through each of these in the slides coming up here. So at home care, this is very popular now. This has grown each and every year. People, when they have some type of, if they can't perform activities of daily living, and they qualify for long-term care services, or they require long-term care services, people want to stay home. They don't want to go into a nursing home. They may not even want to go to an assisted living or to community or to some type of community-based care facility, or like an apartment or townhomes like that. They want to stay home in the comfort of their own confines that they've been living in, essentially majority of their lives or their whole lives. So at home care, that consists, the obvious family and friends taking care. That could also be home health aides. So they could come over and just help with daily activities. It could be the simplest of little things. You could have doctors and nurses that could visit, help with, anything medical, medical related, maybe prescription drugs, helping you with your medications, things of that nature. You also have support services now. An example we give here is, meal deliveries. I used to say meal deliveries like Meals on Wheels, but, with technology today and all the apps, I think we all have support services for meal deliveries at this point. It's not hard to get food delivered to your house, whether it be a meal or groceries. Same thing with medical equipment. There's even, a lot of long-term care out there, or different policies out there where you can that will help you install or purchase medical equipment for your house. So like, for example, if you're in a wheelchair and you can't go up and down the stairs, so you need to install something for your wheelchair so you can get up and down stairs at your home. So that's become more common, where people would just rather spend the money on medical equipment for their own, so they can stay home, versus going into an assisted living or independent living type community. And then you have your case managers as well that can kind of help guide you and just really observe and give you advice, and really just manage, like, okay, how are you doing? Are you getting the appropriate level of care? Do you need, is staying at home still okay for you? Are there any changes that we may or may not need to make to your long-term care plan? All right, next, from, kind of a step up from at-home care would be this community-based care. So you have, this usually consists of, when you see those apartments or townhome, retirement community centers, that's really what we're talking about here. So kind of like an adult daycare, but what's nice with these is the social support. I've actually, through family members of my own, I've been to a few different types of we'll call them community-based care communities right now. And it really doesn't even feel like a quote unquote long-term care service or community-based care facility, because they really do a lot of things to help, with the social support, which I think is the biggest thing. It could be anything from, having euchre tournaments or happy hour with people, or just having the 3 different meals a day, where everybody can kind of get, gather in one room and just have that social aspect still, even though they may not be at home. Obviously, the health services, pretty limited as far as the health service. It's not quite at the level or details like an assisted living or a 24-hour, skilled nursing care type facility. They can even provide respite care for in-home caregivers, such as family or friends as well. Next, we have independent living, and in some cases, this consists of people that, obviously, people that can still pretty much be independent and sustain, most of their activities of daily living on their own. Sometimes that does involve them staying at home, But in most cases, this is when you're in what we, again, we call these continuing care retirement communities. Whoops, looks like we have someone else here. So again, with these independent living, you're going to have limited help with personal care and health care. There's independent living plus, they call it, where, if you kind of bump up to that tier, you need the little extensive service, they'll help you with things such as medication management, for example. And kind of a step above the independent living, next would be the assisted living. So if you start to, let's say you can perform most of the activities of daily living that we just talked about, but maybe, there's a couple of them, 2, maybe 3 of them now. Over time, you just cannot, sustain and perform those on your own. You need a little bit more level of care, a little bit more detail. That's where you have the assisted living facilities or centers. It could be in the same community as the last slide that I just showed, where those apartments, townhomes, those different retirement community centers, it could actually be in the exact same complex. It might just be in a different building or a different facility. And again, you still get a lot of the benefits and perks of that independent living, that community-based living with, the social interaction and whatnot that I was talking about. You're just going to get a little more in-depth care that would be available if you're living independently, but it's still going to be residential. They even let you bring your own furniture, from your own house or any other belongings or personal property you may want to bring, just to make it feel more like home when you're there. So again, here, as you can see, there's still a lot of social opportunities along with that assistance that you'll be getting. Charlie, do we have any questions yet? I'm not looking at the chat.
No, we don't have any questions yet.
Yeah, thank you. All right, so here we have the cost of long-term care broken down. So on the left here, you can see the cost of non-long-term care medical expenses for a retirement couple. Right now, the average retirement cost, this is for a married couple, assume they retire age 65, it's about $300,000. That's in today's dollars. Obviously, we all know there's inflation involved, especially with medical cost. So pretty substantial. Then with cost of long-term care per year, the national median for one person right now is at $51,600, as you can see. Now, I will say, actually, this is not even a week ago, talking to, in a meeting, and, somebody that's actively researching, potential long-term care services and facilities, at different levels. And it was just, it's always interesting to hear when people are doing active research, present day, because I just like to hear what the actual costs are around where we all live, locally. And on the low end, it was like $4,000 a month. And I know, I've had talks with Ryan about this and heard him, talk about this in various meetings. Really, you can easily get up to $8,000 to $9,000 a month, depending on the level of care that you need and just how nice of a, facility or, room, or, setup that or living quarters that you want. So really this 51,000, I know it's the national average, but from just personal conversations and experiences that I've seen and witnessed, that number even seems kind of low. That definitely would be on the low end. And there's an example over here they get, that we put in here about, say like in a, in an area like New York City, which is obviously like in New York, California, you're going to have higher cost of living in general across the board. The low end or the average there is about $72,000 versus that $51,000 with the national median. All right, so this brings us now to the Medicare, Medicaid bullet point from earlier that I said we would dive into in a little bit more detail. Because again, this comes up all the time where people just assume that Medicare or Medicaid, I heard Medicaid, that will pay for my long-term care and all that. Well, there's a few different, surprises that could pose or issues that could pose. That brings us to the second key, is that counting on Medicare or Medicaid is not a plan that anybody wants to rely on for long-term care. And it's just very hard to become eligible, especially for Medicaid. So some of the misconceptions about paying for long-term care costs here. First, with Medicare, it does not pay for any long-term care costs. So I tell people Medicare is health insurance. It's going to pay for healthcare costs, not long-term care costs. Then they say, okay, Tony, aren't those the same thing? No, they're not. They're not the same thing. You guys, what, about 10 slides back, I went over what long-term care, what is long-term care? And I went over the different activities of daily living. That's long-term care. That's how you qualify for long-term care. Medicare is for health insurance. So it's only going to cover and pay for, costs, anything less than 90 days, really. So skilled nursing care and really therapy. So if you need like speech therapy or any type of physical therapy, that's where Medicare comes in. It's not gonna cover any custodial care or independent or assisted living or nursing home, anything like that. The idea with Medicare and the cost that it covers is again, we use therapy as the example because the idea is that you're gonna get better and that you're gonna be back to normal eventually, or at least close to back to normal, where you're, functioning and able to do all the activities of daily living. So that brings us to Medicaid, where Medicaid does cover long-term care, but you're only become eligible if you have a low enough income or pretty much deplete a majority of all your assets, which we'll get into here. So the first surprise of Medicaid is, as I was just kind of segueing into, is you must use up all your assets and have very limited income. So you can only have, I believe it's up to $2,000 in assets that you're allowed to have. So if you have a lot more than $2,000 in assets, you're gonna have to get those depleted down. Also, you can only have, it's anywhere from 100 to 200% of the poverty level as far as income goes. So I actually checked for Michigan for 2022, the poverty level, I believe, for a household with 2 people in it, so let's just married household, you can't have income over, it's like $1,500 a month for a household that consists of 2 people. For a household that consists of just 1 person, it drops down to, it's a little over $1,300 a month. So if you have income above that per month or annually, that also will make you ineligible. So again, very difficult to become eligible. And do you really want to become eligible for Medicaid? If that's how you become eligible? So next surprise we have here is you become disqualified due to what they call a look back period. So at time of application, so if I walk in and I go apply for Medicaid today, they're going to look back 5 years and see, did I transfer any assets? And let's just say I had $500,000 in assets. And for whatever reason, I was like, I want to qualify for Medicare one day, so I'm going to start transferring and getting all these assets out of my name. Now, what they will do is they will actually count that as part of your assets, whatever you actually did transfer, even though it's not in your name anymore. That is still going to count towards and can disqualify you for Medicaid. So as long as the number of transferred assets is more than the Medicaid limit, that $2,000, you will be disqualified. Again, that is a 5-year look back period from the time of application that you apply. So pretty interesting. Not a lot of people know that. A lot of people are kind of aware of the income and having to drain a lot of your assets, but a lot of people aren't aware of this look back period. Now, one thing I did forget to mention when I was talking about how you have to have less than 2,000 assets, you can keep your home. They do let you keep your house. That's kind of them, right? Just for what it's worth. I forgot, I left that point out, which I think is important. And Ryan, I can't remember, do they let you keep your vehicles? Or does that count against you?
Counts against you. Just your house,
Okay.
and then a couple thousand in the checking account, like you said earlier.
All right, next, Medicaid surprise number 3, you know, we say here, no room at the end. So the example I'm going to give to explain this slide is, let's say you are in an assisted living or, you know, independent living, or maybe it's a 24-hour nursing home for long-term care purposes. And you didn't have long-term care insurance, and you're just you're self-insuring, and it's costing you $90,000 to $100,000 a year, and you know you're on year 3, 4, 5, 6 maybe. It's a longer stay than you planned, and you deplete those assets. You deplete them so much that you're under that $2,000 limit, and you actually could qualify for Medicaid. Let's say you do qualify for Medicaid. You know, some people might think, hey, it's not that bad. I now have long-term care insurance technically. Well, here's the problem with that. That may be true, but let's say you're in a nice room that you've been paying for, especially if you know, your costs are that high, you probably are in a decent, you know, probably a decent care center and have a nice room and all that, nice bed with a kitchen maybe, all that stuff. Well, that might not be a Medicaid qualified room or bed. So you're gonna have to change rooms to a bed that is covered by Medicaid, which typically is not going to be as desirable as, you know, what you were probably in already. And on top of that, there is a shortage, no matter what the volume or capacity levels are at all types of long-term care centers or communities or care centers. There is a shortage with Medicaid qualified beds and rooms at, you know, all different types of these facilities. So there's a long wait list there, and that can cause a problem, especially for people that aren't yet in or getting any long-term care maybe, and they qualify for Medicaid. Okay, but that's great. You qualify, you're eligible, but we don't have anything for you. You're gonna have to wait. And matters can only get a little worse with that just because of baby boomers. Like I said, by year 2030, every baby boomer is going to be at least age 65. So they're actually expecting and predicting capacity or occupancy, to increase at these different community centers and long-term care facilities. Yeah, so I kind of got ahead of myself here. So you just going over some additional risk of, you know, assuming the Medicare or Medicaid, you know, covering long-term care is, you know, what I was just talking about, the strained healthcare system due to aging boomers. Excuse me. Yeah, the other big one, paying from your own pocket. That just, again, yeah, I've already talked about it a couple times here. Paying out of pocket, you know, that can just be very, very costly and have a lot of different ramifications that may have been unintended. All right, so some of you may be thinking or said this in the past. I know I've heard this. You know, in the various conversations I have around long-term care planning is, well, I've heard long-term care insurance is not a good deal at all. So is there even any other good options out there? Because I've only heard bad things about it. That brings us to our third key number 3. And I would agree with some of that sentiment. Historically, when some of these older policies, when they first started, they were not very good policies. And we'll get into that here in just a second. So it's very understandable why people kind of avoid making a plan, or they're just really turned off on the term or phrase long-term care in general when they hear those words. So originally, long-term care insurance was actually introduced back in the 1960s, which really surprised me when I first learned that. I always thought it was in the 80s and like early 90s when policies started getting issued. I never realized, you know, when I first really started getting into financial planning, that it goes all the way back to the 60s, which I, you know, found very interesting. You know, and so back then though, care options were, you know, they were very limited. And as time went on, they started to kind of expand those services. And as those options and services expanded, you know, therefore demand for long-term care insurance went up. It actually skyrocketed. So it was really seen as, hey, let's do this. Premiums aren't too bad. And, you know, if it does what it says it's going to do, it's definitely worth, we're definitely getting bang for our buck. So a lot of insurance companies also jumped into this market because, well, I mean, we all know insurance companies are for profit. They saw this as another avenue for a new revenue stream and to drive profits. So some of the challenges with the original long-term care insurance, first is skyrocketing premiums. So you could see premiums. What really was bad about these old policies is they would basically, so when you apply for long-term care insurance, you go through medical underwriting up front. So you do that, and then if you went on claim with some of these older policies, they would basically underwrite you again, and then you'd get a new premium based on whatever claim you made to have for long-term care expense to be reimbursed. So it's like I bought the policy, I go on claim, I submit a claim for $5,000 or $60,000 in a given year, and then they're going to re-underwrite me and increase my premiums based on how much I tried to get reimbursed from my policy. And I mean, that's just not very ethical. It's not very moral. I mean, you have somebody that's sick, not doing well, paying premiums all these years, and they finally want to tap in and use the benefits of the policy, and insurance companies were re-underwriting them and then just jacking up their premiums. It's just not good. It's terrible. And then you had a lot of refusals to qualify the policyholders, for long-term care, and they would refuse to pay claims. A lot of this was because they would require you to be hospitalized for a certain level of care in a certain X amount number of days, or they would require you to be in skilled nursing care for X amount of days, or they weren't going to pay you. So you could be hospitalized or, for a month, 2 months maybe, before, they try to, before they even want to pay you out anything. And they still wouldn't even pay out it sometimes. And that would lead to some policies getting canceled for reasons other than the policyholder not making premium payments. Obviously, if you don't make premium payments on any policy, the policy is going to lapse or get canceled. But they would cancel policies for reasons other than that. And that led obviously to a lot of litigation, a lot of legal battles. So since then, there's been a lot of there's actually 4 separate years, like 93, 95, and early 2000s. And I think the last one was like around 05, 06. There's been multiple different regulatory reforms in response to these original long-term care challenges that I was just talking about. So you can see over here the bullet points, some of the big changes that have been put in place, your consumer protections, we call them. So coverage of dementia, including Alzheimer's, which is a big one. That's a growing concern, growing issue in our country. No hospitalization or skilled nursing requirement, that very key. Clarified terms of what's covered and when. So that's what I like with the policies that we look at today. It is very cut and dry. Here's what we're going to cover. Here's how you qualify to be covered. It's not very confusing at all. It is very straightforward, very simple terms. All upfront underwriting. So again, you go through underwriting up front, you get approved. You're not going to go through underwriting again after you submit a claim to have some long-term care expenses reimbursed. That can't happen anymore. And a lot of these have been in place, like I said, for years and years. These just didn't come into place within the last 5-10 years. It's been a while. It's been like this. Also, the policy cannot just be canceled unless if you don't pay your premiums. And this is another big one too. Regulation on premium increases. So a lot of traditional long-term care policies, they basically could increase the premiums every single year, kind of as much as they wanted. There wasn't a lot in place to stop them from jacking up premiums any given year at some ridiculous rate, and that's really not justifiable. Well, now for traditional long-term care insurance policies, there is more regulation around how much they can increase those premiums in any given period. And as we'll talk about here in a little bit, there are other options for long-term care where your premiums are fixed and flat. They're not going to go up, they're not going to go down. It's just the stated premium is going to be paid over X amount of years. So it's more of a known. Charlie, how we doing on questions? Any yet?
No questions.
All right. All right, so all in all, these original policies or legacy policies without these protections are still out there and causing problems. I've ran into them, not a lot, but here and there I will see some old policies from, issued back, early 90s especially. But yeah, again, very, very few and far between do I run into these legacy policies. Excuse me. All right, so a lot of people kind of, they get to the point where it's like, all right, is planning for long-term care, is it even possible? Is it affordable? Is it futile? Is it even worth it? So that brings us to key number 4. There's some new approaches to planning for long-term care that they've, just different ways to plan or purchase long-term care insurance just to really address people's skepticism and negativity that they've had towards the industry or towards the old long-term care or legacy policies that we were just talking about. So they really provided a much wider range of different options. So like whenever you go to look at long-term care, you're not just going to go look at a traditional long-term care. The industry now is got much more flexible and provided everybody, hey, here's different, 2, 3, 4, 5 different options now that you can pick from. It just allows us to be more customized to your needs. So some of those new approaches, as you can see here, they've just improved the long-term care insurance, the traditional policies. You now can get coverage through life insurance and annuities. These life insurance and annuity contracts, they offer these long-term care riders or long-term care benefits attached to them. Those are nice because they kind of have a 2 or 3 prong benefit to the structure, the way they're set up. Then there's a couple other financial strategies that we'll cover real quick as well. So I'm not going to spend a lot of time on this slide because I've already covered it, to be quite honest with you. The big one here with the improved long-term care insurance. So when I say just long-term care insurance, I just mean a policy that is strictly for long-term care. There's no life insurance component, no death benefit. It is a use it or lose it type policy. If you don't use it for long-term care, then that's it. Now, the main thing with these policies, again, is that all the consumer protections that I went over a few slides ago, and it's really, as far as the benefit or the premiums go, the premiums can still be increased year, any given year, but there are reforms and regulations in place, so it's not going to be anything too substantial or out of control. And they also have protections for rising costs of long-term care. So if you want to purchase like an inflation option with these, where your long-term care benefit increases by a certain percentage to keep up with the inflation of long-term care expenses year after year, that is an option for you to purchase as well, instead of it just being a flat benefit and not growing and keeping up with that inflation. Next is life insurance and annuities with these long-term care benefits. I call it a long-term care rider. So with the life insurance component, what is nice with these, as talked about the 2 or 3 prong benefit, is that you have the long-term care, obviously. So with the same goes with the annuities. The idea with these is to leverage your dollars for long-term care. So say I put $50,000 of premium into one of these policies or contracts. Well, that $50,000 on day one, I'm just hypothetical, that could be leveraged up to, depending on what type of policy you do, that could be leveraged to like $150,000 potentially, just for long-term care. So it's just all about leveraging those dollars and then getting the tax-free long-term care benefit. Now, what's nice with these, when you do it through life insurance or an annuity, especially with life insurance, is that you have the long-term care component, but you also have the life insurance component now. So it's not a use it or lose it. Say you never used this policy for long-term care. You lived a pretty healthy life. You just never needed it for long-term care. Well, a traditional policy, all those premiums that you paid over those years, they just kind of go to waste. But with life insurance now, you have a death benefit that can be passed on tax-free to whoever you name as your beneficiaries. So that is, that's a nice component. It's not a use it or lose it. At least your beneficiaries get that tax-free death benefit. Then also on, with the life insurance, there's also surrender values. There's some times where people pay premiums over X amount of years. And, I've had this where people have had traditional long-term care insurance. They've been paying premiums for 15, 20 years, and they're just sick of paying it. They don't want to pay it anymore. They're healthy. They don't think they're going to need it, or they may have other means to, maybe they just inherited a lot of wealth and they have substantial assets now. They're fine self-insuring. Well, those premiums are gone. It's use it or lose it. But with life insurance, you can actually surrender the policy and you get a portion of those premiums back. So that's what's really nice, where the industry has gotten creative and just been able to provide more flexible products like this. Same with on the annuity side with the life insurance. So you can purchase an annuity with a long-term care rider. There's going to be a death benefit attached to it. As long as, if you go on claim and you use these policies though for long-term care, that's obviously going to drive down the death benefit that's passed on until it's eventually zero if you ever use the policy that much. So you have traditional long-term care, then also life insurance and annuities with long-term care riders as a few different options. So some other financial strategies where you can leverage for these costs, like I've been talking about, equity in your home. That's talking about a reverse mortgage. Not really going to get into that though. That's kind of a last resort type deal. Existing life insurance policies, Roth IRAs, and health savings accounts. So with an existing life insurance policy that does not have long-term care benefits, you have a couple options still. The first one is a life settlement, or some of you might be more familiar with viatical settlements. There's actually commercials. I see commercials quite a bit on these, where you can sell your life insurance policy for a certain percentage of your death benefit. It depends on your age and your health. So obviously whoever's going to buy this, they're counting on you to not live very long, just to put it bluntly, because that's why they're buying out the policy and giving you cash up front, and they get that death benefit payout whenever you pass away. So that's that life settlement or viatical settlement. Don't see or run into those very much. Accelerated benefits. A lot of these life insurance policies have what's called a chronic illness rider, or it could be called a terminal illness rider. So what that is, if you have a terminal or chronic illness, you've been diagnosed with that illness by your doctor, you can actually tap into a certain portion of your life insurance death benefit to pay for any long-term care associated costs. That's why they call it this accelerated benefit. A lot of policies some policies will actually say you can tap into 50% of the death benefit right away. So say you have a life insurance contract of $300,000 death benefit, no long-term care rider, but you have a terminal illness rider, and you're diagnosed with a terminal illness. Well, you can go and get $150,000 right away within the first year or two to help pay for those costs. The idea there is that I want to try to get all my money in lump sum right away for these costs, because I have a terminal illness. I'm not going to have an extended stay at a long-term care facility like assisted living. You can be there anywhere from 3 to 6, 7 years. So that's why some people choose to go that route, or at least have this on the table, have this as an option.
Hey, Antonio.
Yeah.
Steve had a question about underwriting for the combined policy. So I think he's talking about the life insurance long-term care options.
Okay, the question was Just
So
in
what are the-
general about the
Yeah,
underwriting?
what are the
or-
health underwriting requirements for these combined policies?
Yeah, so it's all pretty much the same for Eddie, because it's a life insurance contract through and through. That's the base. So it's going to be the same as if you're just applying for a regular life insurance contract.
Yeah, the
But,
annuities
they're
are,
just going to, they're going to,
the annuities are less strict, right?
yeah, the annuities are much less strict. Typically with the annuities, it's just you're answering a series of yes or no questions. It's, I think, maybe 10 or 12 yes or no questions. And then you do about a 45-minute phone interview that you schedule. And you get, within days or hours even sometimes, you'll get a decision, approve or decline. So that's with the annuities. They're, usually we try to go the life insurance route before the annuity, just because they have a little, I feel like they just have a little bit more bells and whistles as far as what they cover. But both are really good options. But the life insurance is, yeah, they're going to look at medical history, prescription drugs that you may have taken. They're going to pull all those medical records, all that stuff, like they would for any other insurance policy.
So generally, if you're, and correct me if I'm wrong, Antonio, generally speaking, if you're over the age of, say, 70, and or have some health issue, the annuity is probably your only or best option in that particular case.
Yes, typically when you're over, if you have a minor health issue that will not get you approved with regular long-term care or life insurance with long-term care, we go the annuity route because, like you said, Ryan, less stringent. Also, it's just easier to get them through. And when you get over age 70, the life insurance, it just gets expensive. It can get really expensive. And what's nice with the annuity, with the long-term care benefit, is that, we have some clients that might have some non-qualified annuity contracts that they don't need to use or don't want to use. You can use those annuities to fund those long-term care annuities as well. So it doesn't feel like you're paying an out-of-pocket premium expense either. So yeah, it just, again, every situation is different with everybody. That's why it's just important to have a good customized plan, especially for long-term care, because there's just a lot of different options to navigate. All right. So another financial strategy, you can use pre-tax savings, traditional IRAs, that's your pre-tax savings. Roth IRAs, that's going to be after-tax savings. If you need to tap into those assets to cover long-term care premiums or expenses, obviously we try to leverage dollars instead of having to drain these assets, but these are options, especially Roth IRAs, because the money comes out of the Roth IRA tax-free versus traditional IRA where it is taxable. A health savings account. So with health savings accounts, what did I do? Sorry about that. So with the health savings account, obviously, if you want to use this for long-term care expenses or long-term care premiums, those are considered qualified medical expenses, so they will come out tax-free. Not a lot of people have substantial savings built up in HSAs. Some people do, but they're still kind of newish. They're not really new, but historically speaking, they're kind of new. And people just don't typically plan, because you can only put about up to $7,000, $7,200, about $7,200 for a family in these accounts every year. So typically we don't see substantial enough savings in these HSAs, but they definitely are an account that you can use to help supplement premium costs or, even other minor long-term care expense costs. All right, so what about simply self-funding long-term care costs when and if I need to? Yeah, so self-funding, Ryan, correct me if I'm wrong, but, even a lot of people that we set up long-term care insurance for, they technically on paper could self-fund. Again, it's all about, leveraging dollars, being tax efficient, and self-funding is difficult. because it's like, all right, when am I gonna need long-term care? So say I self-fund, well, what if a lot of my assets are in IRAs, and when that money comes out, I got to pay taxes on all that, versus a long-term care insurance policy where the money is leveraged and it comes out tax-free. Also, what if you have years like this year? I worry about with self-funding is just the drawdown of assets and how rapid that can happen. You have a year like 2022. So let's say you had to pull 15, 20 grand out earlier this year for long-term care. Well, oops, your accounts are down 20, 25%, because we all know the markets, they've come back recently, but it's first, second quarters are very rough. So there's an even bigger drawdown now. So there's just a lot of questions, a lot of issues with self-funding. Not saying self-funding is bad or wrong or just, the end of the world, but there's just better options, more efficient options for long-term care planning versus I'm just going to self-fund and use what I have saved up. It's just, it's very tough. And from a tax standpoint, you're really not going to be, you really could be getting hurt and beat up on taxes too. All right, so some different factors that you should consider when making a long-term care plan: age, marital status. Age is a big one, because the sooner you start this, the cheaper it's going to be, or the less expensive it's going to be. It's like anything else. It's like with saving. The sooner you start saving for retirement, the less you have to save per month or per year, versus someone that may have waited 15 years later than you did. Kind of same thing with age, marital status. Maybe you have a household where there's an age gap, and maybe we only need to get long-term care for, the younger spouse, because the younger spouse will be able to take care of the older spouse. Those are some things to consider. Or maybe you're single, maybe you're a widow. Who's going to take care of you? We talk about these insurance or long-term care policies. There's a lot of different concierge services provided with these, where they will help you, find a place, find assisted living, find independent living, find these community centers or retirement communities. Health obviously is a factor, location, military service. There's different VA benefits that you could qualify for if you have any type of military background. Family history is a big one. That kind of goes in with health, family history, and longevity. Assets, we've been in retirement and other financial planning, legacy and estate plans. I don't want to get too redundant. We've kind of been, this is all bringing everything together from what I've been talking about in these previous slides. So 3 questions to consider about your long-term care plan here. I just want to kind of wrap up a little bit and bring everything together. Who's going to provide that care? Where do you want the care, and how are you going to pay for that care? So again, it's not always the best plan to be like, my kids will just take care of me. And that may be the case, but that could cause emotional and financial stress on the family and the kids. Or maybe they're not trained or professional caregivers. Maybe they're not the best at, caregiving. Where do you want the care? Like I said, at-home care is very, very popular. Probably the most popular that I've seen and heard and witnessed is at-home care. But again, there's other good independent living and assisted living places out there. It just depends how much you can afford, what you want to afford, basically. How will you pay for that care? I don't think I need to go further into that, the different ways to pay for that care. 3 points to keep in mind is that, again, everyone's situation is unique. As you could see just a few minutes ago, there's just a lot of different options and a lot of different things to consider when coming up with a long-term care plan. Who's going to take care of me? Where? And how am I going to pay for it? Well, there's a lot of different ways you can pay for that. There's a lot of efficient ways to pay for that. Also, you can receive the care at home, and your plan doesn't have to cover all costs. I haven't talked about this, is that when you have a long-term care plan, a lot of times we're just looking to supplement that coverage. We don't need to go after and cover 100% of long-term care. But if we can cover 50, 60, maybe 70%, well, that's huge. It's going to soften the blow quite a bit on your assets and your wealth. So, that's a big win. So back to that original problem, when it comes to a safe and secure retirement, planning for long-term care, this remains very confusing and again, unaddressed challenge to many people's financial security. So those 4 keys that we talked about here, you see them listed. Long-term care. You don't just have to be alone in a nursing home. There's a very wide range of services that are designed to, make people still, have those health and personal care needs and still get that social and emotional support. Counting on Medicare and Medicaid, that's not a good plan to do, even if you technically could be eligible for Medicaid. Remember, Medicare does not cover long-term care. 3, given the historic problems with the long-term care insurance, it's understandable, again, why people avoid making a plan. But remember, to have back to the 4th key here, there's a lot more new approaches to planning for long-term care. There's just much better. There have been so many improvements and strides that have come a long way over the last 30, 40 years. So again, really the solution is coming up with a custom approach. No one size fits all here, especially when talking about this topic. That's really it, everybody, that we had prepared for you. Obviously, if anybody has any questions, please feel free to ask away. If anybody would wants to just set up a conference call or a separate Zoom meeting with Ryan, Charlie, or myself, or all of us, just to talk more in depth about long-term care planning. I know some of you on this call, we have talked and addressed a lot of this already, but those of you that haven't, if that's something that interests you and you want to do, please feel free to ask away right now or reach out to us at any time to set up a meeting. So Ryan or Charlie, is there anything you guys want to add before I kind of open it up to questions?
Not from me.
Ryan?
I think you covered everything, so I think I'm good. I had a bunch of stuff in the chat for people that wanted to see some comments, but I didn't want to interrupt, so I threw some things in the chat there. Feel free to take a look at that. But other than that, I think you did a great job. So any last questions you guys have before we let you go for the evening?
Nope.
All right. Well, thank you guys. Antonio, thank you. You guys have a good night.
You too, Ryan.
Thank you.
Take care.
Take care.